Federal Reserve Chair Janet Yellen delivered her semi-annual address in front of the Senate Banking Committee on Tuesday, reiterating the central bank's vague stance on when investors should expect a rise in short-term interest rates.
The FOMC's assessment that it can be patient in beginning to normalize policy means that the committee considers it unlikely that economic conditions will warrant an increase in the target range for the federal funds rate for at least the next couple of FOMC meetings.
All right, well, for more reaction to Yellen's testimony, I'm joined on set by Ward McCarthy, Chief Financial Economist at Jefferies. And Ward, it's good to have you here. Welcome.
Thank you. Nice to be here.
So you saw the speech. What did you think?
I did. Well, I thought that your description was pretty apt. It's very vague in terms of when the Fed is going to start raising rates. And frankly, she did nothing today, in my opinion, to delineate the exact timing of when the Fed will initiate the liftoff.
All right, well, let's talk about inflation. I want to play a clip of Yellen talking about inflation. Listen.
The committee anticipates that it will be appropriate to raise the target range for the federal funds rate when, on the basis of incoming data, the committee is reasonably confident that inflation will move back over the medium term toward our 2% objective.
Do you think they'll get that confidence this year?
Well, if they're going to get that confidence, it's not going to happen soon. I think it's most likely to be something that happens, I think, in the earliest in the third quarter and really more likely in the fourth quarter of this year.
All right, now Yellen also said that low oil prices will be a significant overall plus for the economy, but we haven't really seen consumers actually spend that savings at the pump. Do you think that's something we'll see over the next several months?
Well, we have seen the consumers actually been pretty erratic. In the fourth quarter GDP numbers, for example, consumer spending was over 4%. So it made it look very encouraging that the consumers would be spending a lot of the savings at the pump. But since that time, consumer spending's been a little bit more sluggish. So it's hard to tell at this point if they just decided to take a step back after a splurge in the fourth quarter, or if this is something that's going to result in periodic increases in spending, maybe not something that's as consistent that we'd like to see.
All right, now what wasn't mentioned in the testimony was the strength of the dollar. Now, is it really wise to raise interest rates in an environment where the dollar is so strong?
Well, the Fed primary determinant in terms of policy is the dual mandate, as Yellen told us many times over the course of today. But in this particular environment, where she also seemed to put the onus on inflation in terms of determining the timing of a rate hike, the dollar is important because deflationary pressures are primarily coming from commodity components of the inflation measures. Commodity prices are determined in global markets, and of course they're priced in dollars. So when the dollar is appreciating, it makes it more difficult for commodity markets to stabilize and also to begin to rise, which of course is what we would need if we are going to see inflation start to move back towards the Fed's 2% target.
So could a strong dollar delay a rate hike?
Well, I think a strong dollar could delay a rate hike, although I don't think the Fed will need to necessarily rely on the dollar specifically to play this out at a slower pace than a lot of people think. They can just simply look at the domestic inflation numbers, which have been really bad lately. We're going to get a really sharp decline in the CPI again tomorrow. So I think at a minimum, they'll want to see some stability in inflation before they can be confident that inflation is going to move back towards target. And that's going to unfold over a number of months.
All right, Ward, we'll leave it there. Ward McCarthy, Chief Financial Economist at Jefferies. Thanks for coming in.
Thanks for having me, Scott.
I'm Scott Gamm, and you're watching The Street.